We're so pleased to see so much interest in Climate and Community Project's policy visions for the home insurance crisis work. Before passing to the panel, I'll start with a bit of introduction to CCP and why we're all here. Climate and Community Project is a progressive think tank that develops cutting-edge research and policy proposals at the climate and inequality nexus. We, like all of you here, have observed a mounting crisis in home insurance markets in the United States. Worsening climate disasters like more intense hurricanes, wildfires, and hailstorms are making multi-billion-dollar payouts an annual occurrence across the country. Insurance coverage is shrinking and becoming increasingly unaffordable, while private insurers are raising rates or pulling out of some markets entirely. Homeowners therefore face dilemmas like potential mortgage defaults, which are personal risks that could spiral into broader property market collapses. Meanwhile, renters and other households confront future uncertainties with even more limited protections. In other words, the insurance crisis is not just a crisis for an industry, but a crisis of housing safety and affordability. As such, it requires bold, holistic policy solutions that meet the moment of a rapidly changing climate and contribute to climate solutions rather than to the climate crisis. To support the creation of such solutions, Climate and Community Project is working with academic researchers, policy experts, practitioners, and community organizations to both dig into the lesser told parts of the home insurance crisis story and to co-create a broad policy vision that centers housing affordability and sustainability. This webinar and an accompanying blog series are part of our attempt to broaden this conversation, even as we carry out our research and analysis. So we're very pleased to have nearly all of the blog authors or interviewees here today for this conversation. I'll ask each of them a question in turn, preceded by a short biography. We'll end with some time for questions and answers from the audience. So we're going to start with the first blog and the first panelist, Zach Taylor. Zach Taylor is an assistant professor at the Faculty of Architecture and the Built Environment at Delft University of Technology. Zach's work examines how financial institutions manage climate risk in the built environment and what this means for equitable urban climate transitions. Zach co-leads Red and Blue, Real Estate Development in Low Urban Environments, which is a transdisciplinary research platform focused on the development of integrated climate risk strategies in the Netherlands. And for the purposes of this conversation, I hope it's okay, Zach, that I mention you're also a Florida native, even though you now live in the Netherlands. So moving on to the question, Zach, the blog that you and Sarah Knuth wrote gave an overview of the contours of the current home insurance crisis and flagged that much of the dominant narrative about the crisis has focused on shoring up the industry as a primary solution. What gets left out when this is the primary focus, and what kind of approach would lead to more effective responses?
Thanks, Moira. It's great to be here and to kick off this reflection. I think I've got a few minutes here, so I'm going to touch on probably 3 points which are connected. I think in a lot of these dominant framings, as you mentioned, the emphasis is on trying to understand why insurance markets aren't working and what needs to be done to make them work better. There's a lot of focus on how they can be regulated to be more effective, how they can be made profitable, how they can be made solvent. So a lot of the discussion focuses on that as an end goal, as you touched on. And I think some things get missed in that, in particular, really concretely different stakeholder interests. And there are many here. One we focus on in a lot of our work is on residents, on citizens, on housing, on housers, on housing users. And yeah, thanks. One of the kind of key examples here is, a lot of debates about which tenures we talk about when we're talking about how insurance markets work. Homeowners are either explicitly or implicitly centered in this narrative. Homeowners insurance markets are really what we're talking about when we talk about this. There are very limited products available for renters. So there's a massive tenure bias. There's a massive group of people, 30, 40, 50, 60% of the people in the communities we're talking about, which are absent from this conversation about financing risks. That's a huge absence. There are others too. There are many people in the housing system that rely on access to insurance to be able to accomplish their work. We're going to hear about that more in a bit, I think. Affordable housing providers, for example, need access to insurance. Housing developers need access to insurance. There are so many different stakeholders that are interdependent with the system whose needs and interests and priorities might be invisibilized by these narratives. And I think it's really important that we pay attention to those different dynamics. Another thing that I think gets erased in these narratives sometimes is the fact that there are many ways of managing risks. I tell my students to think about risk transfer or insurance as part of a bigger risk management puzzle, right? And there are other ways of managing those risks. You can physically mitigate risks. When we talk about risk, we're talking about valuable things in harm's way, right? And there are many ways of dealing with that. We have spatial planning, we have building codes, we have retrofits, we have all sorts of technical and non-technical levers that we can pull as a society to manage our vulnerability in places. And often we don't think about insurance next to that in a way that is as smart as I think it could be. And that comes back to some of these invisibilities when it comes to tenure. So to give a concrete example, let's go back to homeowners. They're kind of front and center in many of the discussions about the limits of insurance these days. We're all aware of the affordability crises facing homeowners in many places around the world, not just in the US. And within that discussion, we increasingly see awareness or attention to the fact that physical de-risking or retrofitting of housing may or may not be able to help solve some of these insurance market pressures, take some pressure off of the market. But we don't really have a very good view of how these things can fit together. So maybe we have programs for better weatherizing a house, fixing up a roof so it's stronger, adding wind ties, and we have grants and subsidies and so on. But we don't really have strong narratives about how all these pieces fit together. We don't have strong policy frameworks for making sure they fit together. We have a very fragmented puzzle. It's fragmented by place, it's fragmented by risk, it's fragmented by financing source. So these are different narratives, or different ways we could approach the problem, which are about dealing with different types of risks that face different types of people in our society. And that way of approaching it is really displaced by this narrative that really pervades everything. And maybe the kind of third and final layer here, which is the higher kind of level of abstraction, I think, and it's going to connect with some of what I hope Rebecca talks about next. I think some of these bigger political discussions or societal questions about our values are also sort of displaced by these narratives. On the one hand, this is about really concretely the role of public policy and public policy, the state in shaping this conversation. We focus a lot about when we talk about insurance on the market, and there are often overly simplistic tropes deployed about state versus market, when in our work we see just an intertwined close relationship between state and market in the making of insurance as it exists in its current form. And I think that the erasure of this intimacy is really politically limiting when we're trying to have questions about what the state could do to help deal with these fundamental problems. I think that's something I'd really like us to see more explicit reflection on. And I think with this come broader questions about the formal and informal ways in which we have solidarity in our society, because I think that's fundamentally what we're talking about here. And it's not to say that the state's involvement in insurance markets is inherently bad or good or whatever. It's to say that there's a deeper conversation to be had here about how we organize our society and how we try to organize our markets, how we try to guide our markets around broader sets of goals. So, these are some of the things that I think that often get displaced by these narratives. And these are the different types of stories I'd like us to have more often together, and what I hope we're starting to do with this series. So thanks for the question.
Thanks so much, Zach. We are going to pass on now to the next panelist, Rebecca Elliott. Before I introduce Rebecca, I'll just note that if folks have questions that come up as the panelists are speaking, you can note them down and we'll give you a chance to say them out loud in the Q&A session, or you can enter them into the Q&A section. There's a box for that at the bottom of your screen, so feel free to also put questions in there. So moving on to Rebecca Elliott, who is an associate professor of sociology at the London School of Economics, where she's also a research associate at the Grantham Research Institute on Climate Change and the Environment, and at the LSE Center for the Analysis of Risk and Regulation. Rebecca's research focuses on how climate change as a material and symbolic phenomenon reshapes social and environmental landscapes. Rebecca is the author of Underwater: Loss, Flood, Insurance, and the Moral Economy of Climate Change in the United States. So Rebecca, in your blog, you note that a common way to understand insurance is as a tool for managing individual risks through a two-way contract with an insurer. You then explain that there are other ways to understand insurance, including as a social compact. So what do you mean by insurance as a social compact, and what does a lens of looking at insurance that way tell us about how we should think about policy solutions to this current crisis?
Great, thanks very much, Moira. So undoubtedly a lot of the people in this webinar know how insurance works, but for the kind of average consumer, it's easy to think about what you're involved in when you buy insurance as precisely just the contract between you and the insurance company. You pay premiums to an insurer, the insurer pays you if you actually experience a loss, if you get in a car accident, if your bike gets stolen, if you need medical care. But insurance, of course, isn't a form of savings. You're not actually putting money away for a rainy day. As many here probably know, the insurer is taking that money and investing it in income generating assets. And another important way that insurance actually works, right, is that it pools the resources of many people. So I pay my yearly insurance premiums to an insurance company, but so does Zach, so does Moira, so does Paula. We join what insurers call a risk pool, which makes us a community of fate. So if a loss befalls any one of us, right, then the rest of us have put up the resources to make that person whole. So we agree to share our risk. So insurance is a way of taking personal responsibility for potential loss, right? And that's the way I think most people tend to think of it. We're proactively financially managing our exposure to risk when we insure our assets. But because of the way in which it brings us all into this risk pool, it's also a way to socialize responsibility. It smooths out the effects of catastrophe and calamity across a collective, an entire population, in some cases. And so it's, perhaps then not surprising that some of the actual earliest forms of what we might recognize as an insurance arrangement were offered by trade unions and what were then called friendly societies. And so these were organizations that were premised on solidarity and mutual aid. So in essence, to talk about insurance as a social compact is really just to emphasize that insurance actually does put us in a social relationship with each other. And not only with each other, but also with larger institutions like insurance companies, but also governments, right? Social Security is an insurance program. And this is why it's useful to remember this, to understand insurance as a social compact, because of the way that it joins fates together, because of the ways that it sets the balance between personal and collective responsibility. And, I'm not the one who first or most eloquently articulated this. I mean, here I'm drawing directly on the work of legal scholar Tom Baker at the University of Pennsylvania, who pointed this out. And, he actually says that we can learn as much about the American social compact by looking at who is eligible to receive what insurance benefits as we can by reading Supreme Court opinions. I mean, it's that kind of fundamental. He calls it a material constitution. And so I'll just make two further points about this in the time that I have. And the first is to pick up on this point about who is eligible to receive what. When insurers decide what or whom to insure and at what price, they're essentially making decisions about inclusion and exclusion. So who gets access to financial protection and who doesn't. And I think this is where that point that Zach started with about who's left out, right, who's invisibilized becomes really important. The consequences of being excluded are often very serious, as anyone who's ever gone without health insurance in the United States knows. And if we think about the case of property insurance, which is what we're really focused on here, not having access to this kind of insurance, either because insurance companies aren't providing it or because it's prohibitively expensive, that can make it extremely difficult to build wealth through homeownership. And that's because having insurance is a condition of getting and holding a mortgage. For most of us, getting a mortgage is necessary for purchasing property, and purchasing property in the US in particular is a principal path to economic prosperity, right? It's through buying homes that we're kind of expected to pay for our old age and our retirement and the education of our children. To buy into home ownership, and ideally, right, homes that increase in value over time. And so the second point is that insurance is not just a social institution, it's also a moral institution. And so indeed, as Zach foreshadowed, questions of values really matter here if we think seriously about insurance as a moral institution. Because through insurance, individuals are made responsible. And what I mean by that is, when we buy insurance, we're in a sense kind of put in charge of managing our own risk. We can often lower the premiums that we pay if we demonstrate that we've lowered our risk. That's considered financially rational, but it's also a virtuous thing to do. Connecting price and risk in this way is something that insurers call actuarial fairness. So they're actually using moral language to explain that principle. But the reason I put scare quotes up when I said our risk is because that's really actually a very big assumption to postulate that risk to a home of something like flood or fire is something that belongs to us and is something that we have the power to ratchet up or down through our individual virtuous choices. Because we know, of course, that the choice to live in a fire-prone area, for instance, or in a flood zone is the result of many factors, most of which kind of exceed our own powers, predate us, transcend us. It has to do with histories of zoning, of real estate development, economic inequality, government investment. And then once you're there, right, as a homeowner, what you can conceivably do to reduce your risk is also seriously constrained. In the case of fire risk, many of the steps that FEMA suggests are very costly and very complex. And the extent to which they mitigate your risk actually depends on other people doing similar things. And no matter what you do, you're not actually going to change the course of the wildfire. And when these risks are intensifying rapidly as the impacts of climate change are growing more severe, even people that made all the right choices, right, might find themselves in a situation where their exposure seems to grow year on year. And insurance kind of makes us, individual insurance customers responsible for that on some level, and responsible for managing the economic impacts of that. And where homeowners are also landlords, they might then pass some of those higher costs onto tenants. So all of this is just to say that the social compact character of insurance foregrounds what often gets shoved to the background, that insurance is a social institution, it's a moral institution, and that when we sign our insurance contracts, we're also opting into a specific set of arrangements around responsibility, obligation, solidarity. And those are arrangements that can be revised, they can be regulated, they can be rewritten, so long as they're discussed openly and democratically. So if we're thinking about policy, if we start from fair and equitable protection, which is to say, let's start from the objective of making sure that people have safe and secure housing, especially as the planet warms, and go from there, rather than, as Zach just so eloquently laid out for us, starting from the position of what do we do to sustain a working market, then I think we get led into different kinds of spaces and ideas. Thanks.
Thanks so much, Rebecca. So next up, we have Shauna O'Shaughnessy. Shauna has been a passionate and effective advocate for affordable housing for over 2 decades. Since 2019, she has been the president and CEO of the Community Housing Improvement Program, known as CHIP, an affordable housing developer that builds both rental and homeownership housing in 7 Northern California counties. During its 50-year history, CHIP has created homeownership opportunities for over 2,000 households and nearly 1,000 rental units. Disaster recovery housing has become a priority for CHIP in recent years in the wake of the 2018, 2020, and 2021 wildfires. So Shauna, we did an interview for the blog series along with Brendan Mitchell of University Neighborhood Housing Program in Queens. And in that interview, you both talked about how inequities show up in policy conversations and in your dealings with insurance companies and lenders. So, for example, you noted that a predominant narrative about managing wildfire risk is to not build in certain high-risk areas, which might make sense, but when naming those areas where building shouldn't happen, no one ever seems to include wealthy communities like Malibu or Tahoe. So can you talk about some of these inequities that you see being perpetuated among some policymakers and industry actors, and what you think should be done instead?
Yes, thank you, Moira. I'm so excited to be here and participate in this panel as an affordable housing practitioner. I really have the opportunity to share stories from the front line. I am seeing parallels with what we are experiencing as an organization, what our tenants are experiencing, what our homeowners are experiencing, what my friends and family are experiencing in our community with what both Zach and Rebecca have shared and what I know is going to come afterwards. So Community Housing Improvement Program, CHIP, we're located in Northern California, and it is the epicenter of recent catastrophic wildfires, in particular the Carr and Camp Fires in 2018, the North Complex in 2020, and the Dixie Fire in 2021. CHIP lost an apartment complex in the Camp Fire. It's the project behind me, rebuilt. We were able to finish rebuilding it in 2021. And since 2018, insurance has become one of the top issues impacting housing affordability in California for both rental and home ownership. Private insurance companies have become the de facto policymakers interstate, deciding who gets to live where by deciding who and where they will insure, exactly as Rebecca pointed out in her comments. And it is fascinating because insurance has become an essential service, much like a utility, but it's still in the hands of private industry with a huge profit motivation. So I promise I will actually answer your question about my perspective on the conversation about climate risk and where people should be allowed to build and how issues of equity are often left out of that conversation. But first, I'm going to provide some context and history. So California is known to be a rich state, but the majority of our rural regions, which is actually the majority of the state, is not rich. Much of the Central Valley, North Valley, which is where I'm located, mountain regions, and Southern Desert has deep poverty. The average median income for a family of four is half of what it is in our urban areas. And people moved to rural and mountain communities because it was affordable. They could live on their retirement income, they could afford to buy a home, they could build that wealth, they could live a comfortable life. For decades, our region was somewhat insulated from the affordability crisis in our state. If a person could work, they could afford housing, and really even a person on a fixed income could also afford housing. This affordability began eroding in the 2000s, in the wake of the Great Recession. But it didn't really reach crisis levels until we lost tens of thousands of units in our back-to-back wildfires. The Camp Fire, which primarily impacted the town of Paradise, was extremely devastating, with the loss of nearly 15,000 units. Much of it was what we call in our industry naturally occurring affordable housing. Lots of mobile home parks, lots of multi-generation homes. My friends bought their first home for $60,000 just 20 years ago. But the saddest loss after the fire was the loss of community and familial and social networks. We had multiple generations of individual families that lost their homes. Like with Katrina, and there's lots of research and stories on it, we also experienced community-wide diaspora with folks fleeing the state and going everywhere across the country. So the question was, how do you support an entire community of people who have lost everything? So post-Camp Fire and subsequent wildfires, there have been conversations in our legislature, in the media, newspapers, books, TV, at conferences and in forums such as this about climate risk and the wisdom of building in areas designated as high risk, with an emphasis on wildfire risk. I think it's fairly dramatic disaster. So it's pretty clear and people do focus on it. In almost every interview or conversation I had about the rebuilding of Paradise Community Village, which is the apartment complex behind me, I was asked why we chose to rebuild in Paradise. And why would any of the residents of the town choose to rebuild? Should we rebuild? Should they rebuild? Is it safe? And it was very, very hard to respond to this question, because even though we have our answer, and it's like Rebecca pointed out, there's like generations of history in these decisions about where we live. Frequently, it felt like our interrogators had already made up their mind. And often it felt like there was a subtext that anyone who chooses to rebuild is either stupid or naive. The truth is, the decision to rebuild is extremely complicated, and climate change has changed the rules. Areas of the state that used to be safe may not be reliably safe anymore. And unfortunately, there aren't great affordable options or places for people to go. And those that are affordable also have other climate risks. In California, we have so many disasters. We've had years of historic drought. We have coastal erosion. We now have record-breaking wildfires. We have periods of flooding, particularly in the last couple of years, but historically, the reverse had flooded tons. And of course, our dreaded earthquakes. And right now, many parts of the Central Valley don't even have adequate water. Literally, domestic wells are running dry, and the state is spending millions of dollars to dig deeper wells and/or import water for families in small municipalities. This water catastrophe is partially to blame on climate change and California's historic droughts, but it is primarily a man-made disaster, as California's historic water policies have privileged agriculture and the rich, allowing them to take as much groundwater as they want. So all of this brings us to where we are today, where only the wealthy can choose where they want to live, where insurance companies are effectively deciding that only the richest Californians can live on the coast or in the mountains, where our states and communities become less diverse as money and access to insurance becomes the deciding factor of who can live where. Returning to the story of the town of Paradise, the folks who are working to rebuild the town of Paradise are not naive. They just believe that their community is worth preserving, that having a diverse community that includes folks across the economic strata is important. They understand the risks, and they are working hard to mitigate those risks. In rebuilding, all homes are required to be hardened, which is kind of a technical term for protecting against wildfire. Defensible space requirements are stringently reinforced. Overhead utility lines have been undergrounded, and evacuation routes have been improved. They're doing everything that research, including research by the insurance industry, recommends. And they're doing the hard work because for these folks, this is home, it is their community. But it hasn't really made a difference. I mean, insurance has decided, they've basically redlined around the entire town and other parts of California, to be fair, and saying that, no, it doesn't matter what you do or how much mitigation you do, we won't go there. But I want to kind of bring it back to a personal story of why thinking about community and why we live in these areas. So one of the families who moved back into the rebuilt community, Paradise Community Village, shared that after the campfire, they kind of just floated. They had moved to Texas because they could afford housing there, but they never really were able to put down roots. They were never really settled. And their teenage daughter was really unhappy and decided to move back to California, back to this area, and live with friends. And the family didn't want to be separated like that. So the rest of the family eventually followed her back to California. But because of our housing shortage, because of our housing crisis, they weren't able to find adequate affordable housing. when we were finished rebuilding Paradise Community Village, they were thrilled to move back in and be able to bring the family back together. And really, 3 years after the fire, they were finally able to start to put down roots again. And they were finally able to start recovering from their trauma. And since this panel is about insurance, it makes me wonder how we've come to a place where insurance companies' profits are more important than the stability of families and our community. And so I'm going to turn it back to Moira and the other panelists, but I'm so thrilled by all of this conversation and kind of the support for our experience on the front line with the data and the research that we're hearing today. Thank you.
Thanks so much, Shauna. Really appreciate it. So next we're going to hear from Paula, and this is a great follow-up to actually what Shauna was just sharing. So Paula Jarzabkowski is a professor at the School of Business at the University of Queensland. She's a global expert in the public-private mechanisms proliferating around the world to address the disaster insurance protection gap. Currently, Paula is researching how we can transform the insurance market to be a partner in adapting to climate change, including how innovations in disaster risk financing and risk pooling can be linked to property resilience measures to support climate adaptation. So Paula, in your blog, you examine the effectiveness of risk-reflective pricing, which is an industry practice that charges higher premiums for properties more exposed to climate risk. Proponents of this practice argue that the owners of such climate-exposed properties either will move away from the high-risk zones or will undertake structural changes to reduce the risk of a loss to their properties. What does your research and the research of others that you've examined show about how well this theory works in practice?
Yeah, so I think that the underlying principles of the higher price for those who bring higher risk, to some extent, Rebecca already spoke to that. I mean, the whole point of the way insurance work is you get a collective pool and, the premiums and many pay for the losses of the few, but we don't want some people free riding or those who bring higher risk, to that pool, their prices should reflect that. And, we have some sort of conventional beliefs in that, in a sense that, for example, younger drivers typically are charged a higher premium for the first few years because they're a higher risk. We know that they're a higher risk category of driver, for example. And we also make assumptions, about like, well, we will give you an insurance policy against theft because you have certain kinds of locks and things on your house. So we make these assumptions that you will get a lower price if you do these certain types of things like the locks on your house. If you're higher risk for that, then you should get charged a higher price. That's these higher risk young drivers. And so somehow that wisdom is carried through, but it no longer applies in the context in which we're in. So in itself, in principle, there's nothing wrong perhaps with encouraging people to take better strategies, to look after themselves and reduce their risk, and to charge something more to those who bring more risk. But when we look at what's actually happening, and we're seeing really exponential rises in insurance prices. So we're seeing, for example, in the country I'm living in at the moment, Australia, 1 in 8 Australians, that's 1 in 8 Australian households, that's a large percentage of your population, faces extreme insurance stress, meaning in excess of 4 weeks of gross household income in order to buy a meaningful insurance policy. Like, I encourage anyone on this call to think what 4 weeks of your gross household income is, and then think that paying from the net, you pay net household is what the income you have to buy a policy, that's what you would need to spend to buy yourself a meaningful premium. Now, we just know that this is not some minor price signal rise. This is kind of something that was beyond the means of most people. So when we think about that, I think we want to first understand we're not talking about some minor thing that you can do some little tweaks. We're talking about massive changes in the affordability of a premium. And then the argument, of course, is always that, but we shouldn't do anything to suppress that. We should do nothing to support these people. We shouldn't do risk pooling. We shouldn't subsidize, because in doing so, we're taking away this beautiful, clean signal that will make them either relocate or mitigate. But it doesn't actually stack up very well in practice. So let's think about first this relocation argument. So some of these people have been in these properties, taken out mortgages on these properties before they became such high risk. So we're seeing things where people who've never had a claim, in fact, are facing massive rises in their premiums because of the changes in the market itself and the way that, risk itself has gone up. So what we're seeing is that people have been in a house for a period of time, they've taken out a mortgage, they've done so prudently, and then the risk profile of the area around them, the risk profile of the weather has changed the price that they will get charged. So they actually haven't done something that they can change that will therefore change their price signal. Rather, the price signal has happened to them. And so we can say that for those people, this price signal came too long into their property ownership journey, and it came in a way that they had no choice to change the underlying conditions. It's not like putting more locks on your house, if you see what I mean. It's not like just being a young driver, and as you get to be a better driver, then your premium will go down. This is something that occurred through no fault of their own. So that's the first point I'd just like to point out. It's not like they're responsible and can change their responsibility. Secondly, the idea is, well, why don't they just move? They should just move. But there are lots of reasons why people don't move. And some of those are actually, you're saying economic rationale. You're saying an economic rationale, if the price is high, they will move. But actually, there's an economic rationale to stay. Maybe you can't sell the house anymore because it's known to be in a high-risk area. Maybe there isn't anywhere that you can buy because we know that there are housing markets that are tightly constrained. This is particularly bad for those who are lower income, and maybe their houses are of lower value because they can't simply trade out of the house they're in to buy somewhere else. So we're saying to them, well, a logical decision, an economically rational decision for those people might be to stay right where they are, because at least they do have a home, albeit one they can't insure. Perhaps they have a job. Perhaps they've already lost the ability to rely on institutions like insurance, and therefore they are better to stay somewhere where at least they can rely on the other social supports they have, like community. So I think we make a lot of assumptions about relocation that just don't stack up, and they don't even stack up economically. People say, oh yeah, because people aren't economically rational. Maybe it's economically rational to stay in the house that you can actually own rather than sell it when you have nothing else to buy and you don't have a job somewhere else. So I think even the economic rational argument doesn't stack up. The other one, of course, is mitigation. Well, change something about your house and your insurance price will go down, like putting locks on your door, and that will help you to get a policy against theft. But it's not simple as that. And in fact, I really would love someone to give me the data on if you do X, Y, and Z to your home, your premium will go down by this much. That is really a very weak link at this stage, and particularly because we aren't 100% sure in things like flood, for example, precisely what things will lower your risk. And also what we're saying is to the individual, you change your home and your price will go down. But actually, you change your home, but you can't change the weather and also the infrastructure around you. And you can't change the planning and the development that has meant that water runoff happens in a different way now. So it's not just your house, but maybe it's the entire suburb that needs to change. Maybe it's a density of changes that need to be made to all the houses in that area before any one house will get a benefit. And look, insurance companies know that. So they don't actually put the price down when you make a mitigation. So I'm all for mitigation because anything that makes you safer is a great thing. But telling me that mitigation will definitely get you a better premium, I don't see the answers to that, and I'd love to be proven wrong, so please do prove me wrong if you have substantive evidence on that. So I think what we're seeing here is a real illusion of choice in this price signal argument. We're saying, well, we set a high signal, we should never intervene in that signal because we're then changing people's good behaviours. They will make better choices if we leave the signal high. But that's an illusion of choice because they can't choose to change the risk profile. They can't choose to change the weather, and they often don't have any choice about where else they might go that would be affordable and would give them a reasonable standard of living. So the choice they make to stay may actually be the best choice they could make under the circumstances. So what should we do about this? Is price a bad thing? I mean, I think the price signal isn't totally a bad thing. I do have some arguments, and our book is about, in fact, risk pooling and subsidizing insurance risk. Subsidizing insurance on its own, it's true, will be problematic because the underlying risk will increase. And please do feel free to read our book if you'd like. It's open access and free. But the thing that I think we really want to be thinking about is, if we're subsidizing to keep people insured, then that's an important thing to do to allow them to have home ownership and things. But we also need to be working on what is the price signal. We should be aware of the signal even as we subsidize to keep them in the insurance pool. And we should say, what is this price signal telling us? These are the people at the forefront of climate adaptation. How can we work with them on something that will make it sustainable for them to keep living either here or progressively transitioning away from here and bringing them in along on the journey? Because the signal is actually really valuable. It says these people are at the forefront of climate change and they face a lot of risk. So what we should be using is that signal to help make better decisions about those communities.
Thanks so much, Paula. So we're going to pass on to Mackenzie. Mackenzie Marcelin is a Florida resident and the Climate Justice Director at Florida Rising. Mackenzie works to build towards a future based on the principles of climate justice and just transition to ensure that Black, Brown, and Indigenous communities are leading and not left behind as we develop solutions to the climate crisis. So Mackenzie, in our interview, you talked about the need for a shift towards what you call a system that centers on a just and equitable recovery. You said rising profits should not be the priority. Safety should be the priority. So what are some of the barriers that you've seen and experienced in Florida to this kind of just and equitable disaster recovery? And what are some of your ideas for removing those barriers?
Yeah, that's a good question. And, want to start off by saying, like, love this group of panelists. I don't pretend to be an expert on insurance, but just living in Florida, interacting with my community, seeing a lot of just the issues that arise for our communities. And, obviously affordability is a huge thing, leaving a lot of our communities making the decision on going without insurance, right? And especially living in Florida, we are we are on the front lines of the climate crisis, right? You said it in my bio. I'm a strong believer in just transition. We need to shift away from a system that focuses on profit, focuses on extraction and exploitation, into a world that centers people, that centers this planet and the existing relationship between those two. And I think that's just a major thing. We need to shift that thinking. I remember it, I do a lot of utilities work myself. And I remember during the pandemic where everyone was locked in their homes, and that's just an example of the importance of housing, but also the importance of utilities. The power. If you don't have power in your homes, it's ultimately just a box, right? And so. I remember during that time, like the largest utility in Florida, FPL, was in the process of lifting their moratorium, their shut off moratorium, right? They had a moratorium where that even folks that weren't able to pay, that they essentially, yeah, like I said, we're preventing shutoffs for a period of time. And that was important, right? Because it's a necessary thing, right? We need, in this day and age, power is vital, and it's a right for us, right? We need that. And I remember that company, Florida Power and Light, they were, in the process of slowly hinting that, okay, we're going to end this in the moratorium. Again, still in the midst of a pandemic, still in the midst of people being locked down in their homes. And they were thinking about lifting that moratorium. And I remember talking to an elected official about this very situation, and was like, oh, we need to do something about this. It's not the time. And that elected official is like, oh, but how are they going to get paid? How is this company going to get paid? How is this $1 billion company going to get paid? And not even a $1 billion company that each quarter kept on getting higher record profits, right? And I think that type of thinking is a barrier within itself, right? We're not prioritizing people. We're prioritizing these corporate entities. And I think an insurance company is very much the same thing. We need to shift away from thinking about like, oh, how is this company gonna continue to be profitable and successful and whatnot, and really just focus in on the safety of our communities, making it more affordable, strengthening our homes, and also having, providing public options, right? I think those are some of the things that we need, that are critical, for us to live and thrive, especially under in the midst of a climate crisis, right? It's not something that is, the climate crisis, like for so long, we've thought of this as something that's like, oh, that's going to be 20 years, 30 years down the roads. You see a lot of the goals that people, companies and governments set are like, oh, in 2050, we're going to be this. In 2060, we're going to be like, it's here. It's here. It's right now. This earlier, this past week, in Tallahassee, tornadoes tore apart so many businesses and homes, and we know this is going to happen. We've seen the prediction for hurricane season. Hurricane season, that's half the year, right? We don't think about it that we just say June through November, but that's that's essentially half the year. And now we're at a point where, yeah, like these predictions are we're seeing more frequency, and we need to stop thinking about a company, the insurance industry, as private companies, as something that we can get money off of, but as a system that is strictly there to help and prepare us for these disasters. Right. And I think that's just, for me, those are a lot of barriers. One, ultimately, just keeping the money out of politics, I think, is also just a heavy priority. But that's a different conversation. But ultimately, I think it's just, we need to shift that focus from, focus on safety of people. And I think I'll just say this last thing, like, I think we've seen, like, throughout, and we have this insurance conversation, I think a lot of electeds and the narrative out there is that we're focused on people not taking advantage of the system, and not enough on how the insurance company is taking advantage of people. And I think that's just that is just, for me, is so critical. It's so critical. It's so necessary, and we need to undo that thinking and focus again on safety of people, because, again, like everyone says, like, the climate crisis is here. The climate crisis is worsening, and we need to make sure we center our most vulnerable communities, because those are the folks that are often left behind. And if we do center on our most vulnerable people, on our most vulnerable communities, I think that'll make sure that everyone else is safe as well. And so, yeah, I think that's that's all I have to offer up. But I think we just ultimately just shifting the focus and making sure that we prioritize safety. So
Thanks so much, Mackenzie. All right, we're going to move on to our last panelist, and then we'll have Q&A. Our last panelist is Jordan Hetler, who is a climate financial policy consultant with experience as a legislative aide at both the federal and state level. Jordan previously served as staff for the U.S. House Financial Services Committee, covering a portfolio that included monetary policy, financial stability, and insurance. Now, Jordan is a consultant to the Sunrise Project and Climate Cabinet, and is working to advance climate financial policies within the context of state government. So Jordan, in your blog, which you co-wrote with Tracy Lewis of Public Citizen, you highlight how the crisis in home insurance markets could quickly spill over into other parts of the economy, like mortgage markets, potentially leading to an economic crisis similar to what we experienced in 2007 to 2009. But you write, regulators are generally moving in the opposite direction of what's actually needed to prevent a deepening crisis. What are some examples of that, and what should they be doing instead?
Thanks, Moira. Yeah, so the general thrust of state legislative responses seen in a number of states, but most notably Florida and Louisiana, has been to accommodate the insurance industry's demand for higher insurance premiums by deregulating and reducing the barriers to rate increases, while also making it harder for policyholders to sue insurers or challenge underpayments or other problems with their claims. And these insurance overhauls are exclusively focused on the price signaling theory that Paula just described. They're meant to entice insurance companies back into the market, and the theory is that higher premium prices that come along with them will force the public to accept all these harsh realities about where they can and should live. But there really isn't any evidence that it's working, even to keep larger insurers from slowing or adjusting the pace of their market withdrawals. And really crucially, insurance policies are set annually. So even if there was evidence that these enticements were bringing insurance companies back into the market right now, there'd be no guarantee that they'd remain or take any steps in the future to make insurance markets generally more healthy or affordable. The Financial Stability Oversight Council, or FSOC, which is a powerful body of federal financial regulators that was created following the 2008 crash, recently put out a new rule that revitalized its process for designating systemically important financial institutions. And that includes recognizing how financial institutions beyond large commercial banks, like insurance companies, contribute to systemic risks and therefore should be subject to strengthened regulatory oversight. And when the FSOC did that, they laid out all these criteria for what should trigger concerns and potentially cause a systemic designation. And it's really striking to read those criteria because insurance companies are particularly relevant and highly exposed to all of the channels that FSOC listed for amplifying systemic risk. So in an attempt to recognize what a big channel insurance is for spreading climate risk throughout the financial system, the Federal Insurance Office issued a series of 20 recommendations for how state policymakers can fill gaps in insurance regulation and basically promote solvency, that is, making how regulators can make sure that insurance companies are holding enough capital to withstand all the ways that climate change is threatening their business, driving bigger damages, and putting the public on the hook when we're exposed to all these growing costs. And those regulatory reforms are really needed to be a part of the discussion when state legislatures undertake insurance policy reforms. But right now, the insurance lobby is by far the loudest voice at the table. So as a result, these insurance policy overhauls are entirely about agreeing to their demands without even so much as minor trade-offs in the form of consumer protections or strengthened regulations like the ones that the Federal Insurance Office recommended. And lastly, I wanted to follow up on many of the points that Paula made, because just as price signaling and deregulation has been shown not to work, especially when tried in isolation, we should strengthen our regulatory system through the reforms, but that has to be done in tandem with other reforms, especially efforts that seek to fix our slow and broken disaster relief system. The Biden administration has put forward billions of dollars in climate resilience and hazard mitigation resources. And as communities take advantage of that funding, they're taking advantage of that funding against the backdrop of a climate crisis that's escalating quickly and a set of risks that are evolving all the time. So we can't necessarily trust certainly the insurance industry, but a number of other stakeholders to manage how those risks are amplifying and growing and changing in ways that we can't necessarily anticipate perfectly today. So any solution that's put forward is going to have to be a comprehensive one that empowers public institutions to manage the resources and considerations that this crisis is inflicting for years to come.
Thanks so much, Jordan. And thanks to all of the panelists for their really interesting and important comments. And now we're going to move on to some Q&A for some more, and we'll get some more, even more interesting and important comments, I'm sure. So we have a question here about rental markets. So you mentioned that the troubles in homeowners insurance markets, including higher premiums, could hit or are already hitting rental markets. Can you point us to any evidence or research into this dynamic? In other words, to what extent are higher premiums being passed on to renters from landlords? So yeah, any folks want to speak to the research? And then I'd also love to hear, particularly from Mackenzie or Shauna too, about their direct experience.
I'll speak about direct experience first, and then it sounds like Zach had talked about this too. So we are an affordable housing provider. So we build and then we own and manage. And we have had 200 to 300% premium increases over the last 5 years. We are not able, and nor do we want to as a mission-based organization, but we're not able to pass these costs on to the tenants, which means it is creating organizational stress because we have to find other sources of funding when rents can't cover the cost of insurance. But just talking to my colleagues in affordable housing and in rental, market rate rentals are also being hit, and absolutely it makes sense when you're profit motivated to pass the costs, the additional operating costs onto your tenants, because it's very, very hard to absorb such exorbitant increases.
Yeah, just to quickly chime in, I'm not aware of any systematic research on the topic, but I hear a lot of anecdotes. And if you do a survey of media in regions that you follow that are really hard hit, this topic comes up, right? You see it, you see interviews with landlords, and sometimes they're small mom and pop types too. They're not just big corporates who are saying, yeah, I don't know, I'm struggling and I've had to raise my rent by this amount because this policy went up by this much. And I think it would be great to see more research on how and where this is happening and to what extent. I would really value that insight. I can only say, on a more informal observational sense that it's definitely happening. And we're talking about, examples of hundreds of dollars a month being passed on in rental increases. So when we hear also these stories about massive increases in rental pricing, I think we need to think about what the climate related and insurance related signals are that are there. I think there are some.
Yeah, similarly, just like, personal experience and experiences I've seen from like my community members, like I've heard, folks said that like their insurance was like at $400 and it skyrocketed $500, right? And then it's a thing, you know what I mean? Like you get new appliances, you get a new appliance or something like that, your bill's going up, right? You know what I mean? As far as rentals and similarly, if your insurance is going up, like that cost is like it more than likely it's just gonna pass on. And for me, I think it's just like again, love to see the data as well, but it's just there aren't protections for tenants and renters. And so these types of things, it's easy for it to happen. You know what I mean? Like there's not much barriers to stop the cost being passed on. So I'm not surprised. I wouldn't be surprised if the data bore out that, right? You know what I mean? Like, because like, we know that that especially in Florida, like tenants do not have rights. They're at the, it was actually 2 years ago, we fought at the local level for tenant rights, making trying to have rent caps, making sure that either rent freezes or rent caps, things like that. But that was at the legislative level preempted, right? At the state level is preempted, and so it's just an open window for exploitation of tenants, and it's visible, right? And so if you leave the lane open, why wouldn't these businesses, again, that are focused on profit, take advantage of that very system?
Yeah, thanks all. Yeah, we're getting a lot of good questions, so I'm going to move on. So another question here, and maybe this one I'll pass to Jordan because I know you've done a little bit of research on this. Most major insurance companies are insuring and investing in fossil fuels that, of course, are driving the climate crisis, even as the climate insurance crises get worse. What can homeowners do about that in response is what the question says, and I'd also add, are there any sort of regulatory or policy responses? So Jordan, if you have thoughts, others can chime in as well.
I'm appreciative of this question, focused on both the underwriting side and the investment side, because while it is important to understand that insurance companies have been warned for decades and have studied this issue extensively, that the climate crisis is going to inflict major threats for their business, they continue to underwrite and insure LNG terminals and other pieces of fossil fuel infrastructure. But that's not the only problem, and it's not the only problem from a financial stability standpoint. The West Coast insurance regulators, the insurance commissioners from California, Oregon, and Washington, put out a stress test of the investment portfolios of the insurance companies domiciled in their states back in February, and tried to estimate what the exposure of these large insurers would be from a sort of institutional investment standpoint. And insurance companies are some of the largest participants in the corporate bond market and the municipal bond market and a number of other important financial channels. And what they found was that there is a huge exposure to the fossil fuel industry, and that the risk of those assets becoming stranded will amplify stress. And so that needs to be integrated into scenario analysis and some of the other ideas for forcing insurance companies to look beyond the annual policies that they set, and explain to the public how they're going to transition their industry to address the climate crisis. There are some bills in Connecticut and New York that would institute a surcharge on the underwriting and even investment of fossil fuel companies by insurance companies. There really haven't been that many bills introduced around that idea in that many states. So that's one thing that has been floated in a couple of states. But importantly, I think it needs to be, you have to handle it by focusing both on the underwriting and investment side. And you have to look at the whole of business and really understand insurance companies as an institutional investor, not just as a provider of insurance.
Thanks, Jordan. Somebody else want to chime in on that one? Not seeing anyone jump. Okay, we're going to move on then. There's a question here about opportunities to regulate or provide insurance at a level higher than states. For example, federal regulation of insurers, larger multi-state risk pooling, or even federal all-hazard policies. So of course, I'll note that there is a federal law that actually requires the states to do most of the regulating. And maybe I'll pass it first to Rebecca, since you have studied greatly the National Flood Insurance Program, which is this is the existing example of this, and talk about that. And of course, others can chime in after.
Yeah, thanks. I'll say just a little bit about, the one kind of public model we do have, which is flood insurance. But then I really want to hear from Paula on this, because the book that she mentioned collects examples of different ways to pool risk. Not hypothetical examples, actual examples, of different kinds of ways to organize public and private risk sharing that we can learn from. But very briefly, indeed, so in the US, right, flood insurance for most people is provided by the National Flood Insurance Program, which is a federal program, and so it's pooling risks across the country, North Dakota to North Carolina, and everywhere else. And a lot of people fault the NFIP, talk about it like it's a broken program because it's been massively in debt since Hurricane Katrina. That's true if you're thinking that a public insurer should balance the books the way a private insurer would or aspires to, right? But it's a public program, and it's always had other kinds of public objectives, which have included literally underwriting the American dream. It was developed at a point in American history where there was a lot of public policy going into expanding home ownership to more and more Americans. And the conditions that created the National Flood Insurance Program are not terribly dissimilar to the conditions that are emerging around fire in the American West, where you had some catastrophic floods, the handful of private insurers who were underwriting flood pulled out, and the federal government came in to kind of step into the breach. Now, there are a lot of issues with the way that the federal flood program is designed. I mean, it doesn't actually socialize risk as broadly as it probably should. But the idea of a kind of public model of catastrophe insurance is not a foreign one in the American context. Even though we tend to think that Americans prefer private markets for all things, we haven't for flood. But now I'd also really like to hear from Paula about this.
Yeah, I think that there are opportunities and also very good models around the world. And, as I said, I've popped the link to the book in the it's open access because the European Union, fortunately, bought the open access on our book so that people can have the e-copy for free. We looked at 17 of these public-private collaborations to provide disaster insurance in 49 countries around the world. And we've tried to render it somewhat understandable, both to understand why insurance doesn't work in the private market anymore for certain types of risk. But also one of the things that I think we can see is where there is a really proactive risk sharing between government and the private sector. And I think one of the things you've pointed out, Rebecca, is the private sector withdrew and the government came in. The models that seem to work best from my perspective are where you have the private sector still actively offering the insurance policies and having some skin in the game for a threshold of the risk. And then you can either have a reinsurance or an insurance pool taking a percentage of that disaster. The ones that work the very best are the ones that are multi-peril, so you're diversifying across all the risks in a country. And this is something that many people struggle to appreciate, but that are compulsory. Okay, but the point is, if it's compulsory, then everybody is insured. Those can be a flat rate insurance scheme. So everybody just pro rata to the value of your property has insurance for the disaster component. So the disaster component, when you buy your policy on your house, disaster component is shared between your insurer and the state, or state as in the government insurer. There's always resistance to those in countries that don't have them. But actually the thing that we found, and this is in Spain, France, and Switzerland, is where they are already embedded, the private sector generally seems to feel, well, this is the way the market works. It works well. Everybody is insured. And we get all the other stuff and we only have to share a percentage of the most volatile risk. So, I mean, it really can work. Can you make it work easily? Is it socially and politically contentious? Yeah, but is the thing we've got working? So I'm saying, yes, obviously it can be made to work because there are models that show that it works. Is the thing that we currently have, which is let the market rip, working? No. So under the circumstances, perhaps we should start really trying to work out how we can do this. The biggest arguments I hear in market economies, and I live in one, it's not fair. Because it's not fair because, I live on the hill. Why am I subsidizing those lazy, bad, immoral people who live near the sea or the river or whatever, But if you make it multi-peril and it's a flat rate, and then everybody is joining the great big pool and we're diversifying the risk. The truth is we will all pay one way or another. This is a way of getting everyone's skin in the game. Even for these multi-perils, I will say this, as risk rises, they also face the problem. They can't fix climate change, but one of the things that I think is very valuable, and chapter 5 of our book looks at this, is because they own so much of the risk of a country, in the way the private sector will only own bits of the risk of a country. Yeah, whoever it's got insured, it'll only know about that. But if you're the compulsory insurer and you have to take all the risk, you learn a lot about it. And you can use that to start building in risk mitigations and resilience. You can feed into the disaster resilience ecosystem. So I think we have the opportunity to create virtuous circles, and it's not just a theoretical model because we can see it working in some countries. Is it easy? No. Do even those things create challenges? Yes, but I think they offer us a vision of a better way to do this.
Thanks, Paul and Rebecca. This next question is a bit of a tag on to that. So maybe, Paula, if you want to jump in and others after. I'm seeing smaller municipalities actively choose to ignore emerging climate risks like landslides because they can't afford to address them. How should governments be thinking about these problems with price tags too big to tackle?
I can chime in. Yeah, no, I mean, give these municipalities the money. Like, I don't know what else to say. We have, like, especially in the, in US, like we have the money, you know what I mean? The IRA bill just passed. That was like, a plethora amount of money that's sent down to support and and address these climate problems. And I think the money's there, you know what I mean? I think it's just like how we allocate that money, right? If I had $200 to my name and I spent the 190 on like clothes and video games and said like, oh, I only have $10 for groceries, you know what I mean? You'd be like, this is just a budgeting problem. Like you need to prioritize one or the other, And so I think, we have a big problem, the climate crisis, and I think the money is there. I think it's just about allocating the desire to allocate it towards the things we should prioritize, which is the safety of our communities. So yeah,
I could jump in a little bit here. I think there's a lot of different factors that I hear in different communities, also in different countries. When I talk to municipal actors in particular, I think one of them is definitely capacity, which connects to the IRA question a little bit. And part of that is technical capacity, like the right people with the right skills to sort of figure it out and line it all up. And I think especially smaller municipalities obviously run into hurdles here. And I saw a report the other day on our IRA spending, and you really see the slowdown. Like the money is just not being taken up at the state and local level. And I think part of that is just a really straightforward capacity issue. We're not ready to sort of organize ourselves. Part of it is also about fiscal capacity. And I think a lot of that has to do with the sort of rules of the game, the sort of political economy of municipal finance in the US in particular, which is what I'm most familiar with, and particularly in places like Florida, which is an extreme example, but to some extent applies to many places in the US and beyond, where all of the financial incentives that are sort of baked into things run counter to openly embracing climate risk. And within that sort of game, which is often based on securing the value of property markets, there is a very real, I'm very sympathetic to the reality of the risk of undermining the very thing that gives any kind of fiscal capacity or agency to that local government. And that's a very, very real reality. And there's a lot of great scholars who are thinking about this, like Linda Shai at Cornell, who are thinking about ways of regionalizing municipal finance, re-regionalizing to enable them to get over some of these really systemic barriers that lead them to either avoid risk or make perverse decisions. In some of my work on Miami, I call this, develop or densify to defend. You need to intensify your development in vulnerable areas to defend it, because you need that development, that taxable value, in order to finance your risk reduction. So you get these really perverse situations where people are handling risk, avoiding it or leaning into it, or contouring risk management approaches in ways that are really counterintuitive to fundamentally dealing with the risk in more equitable ways. So there's lots of kind of unpack there. I think there are some other things. There are real concerns about liability. What happens when you openly talk about and acknowledge information? I also see that in the private sector a lot. They don't want to talk about it because they know they're sitting on a real problem. And then there's just good old-fashioned politics, and some of it is ideological, and some of it is about, I think, people, local decision makers, grappling with the real material pressures that people are facing. We have a housing affordability crisis, dealing with climate risk, the possibility of devaluing houses or of having to raise taxes to deal with things. That's not easy. And I think not everybody is in a position where it's easy to navigate that pathway. And some of that is really sympathetic, I think. So in short, it's a complicated puzzle. I think a lot of it has to do with how we resource the expertise and the financial capacity we need to organize things. But a lot of it is really fundamental and more structural, and it's woven into our political system and our municipal finance system in the US. And we probably need to grapple with that too, to make it even more complicated.
Thanks, Zach. And thanks, Mackenzie. Okay, so Bernie, I see you have a hand up. You should be able to unmute yourself and go ahead.
Great. Can you hear me okay?
Yep.
Super. So I wanted to offer a couple of comments. In terms of insurers, it's not just their failure to divest from and stop underwriting climate endangering activities. It's their long history of denying any issue with climate risk. We started working with insurance regulators in the early 2000s to develop a climate risk disclosure, and insurers opposed that for 2 decades. So basically, the insurance companies lost decades, and they decided to take the approach of shifting risk onto consumers through higher deductibles, exclusions, caps on coverage, and whatnot, instead of partnering with individuals, businesses, and communities for loss prevention and loss mitigation. Which brings us to the sort of the funding issue, which is that insurers have tremendous amounts of money to invest. And they could be investing in loss mitigation partnerships, but they're not doing that. There is a bill in Congress, the Insure Act, which would prompt insurers and local and state governments to develop funding partnerships in collaboration with the federal government for loss mitigation and also for affordability issues. But I wanted to just finish up that in terms of public programs, the problem with most of the ones in the US are that they give the insurance companies a free ride. There's one good example, which is the terrorism reinsurance program, which provides a federal reinsurance layer in exchange for companies having to offer the coverage. Right now, there's virtually no public reinsurance except at the state level in a couple of states. And most of the states have to deal with the availability issues through a residual market that's limited to a particular state. So they can't diversify. They actually concentrate risk. So you have Florida citizens or Louisiana citizens or the Texas wind pool, which concentrates the risk of wind in a particular location in a particular state. And they have to then go out and buy reinsurance for that super high degree of risk. And of course, the demand for global reinsurance vastly exceeds the supply, which means that the global reinsurers can set the price. So the Insure Act actually tries to address all of those issues, but the basic problem is that insurers have never been required to sort of step up to the plate. And the idea that deregulation will bring insurers back into the market, the way the new commissioner in Louisiana has been touting all of these deregulation reforms, is nonsense. I mean, think about the health insurance market in the US. Would deregulating the market lead to more people being insured? Of course not. All of a sudden, you'd have people being excluded for pre-existing conditions. You'd have folks being charged exorbitant rates because of their health condition. And yet, you know, it's the exact analogy to the current homeowners insurance market where people are being denied coverage because of essentially pre-existing conditions. They now live in an area that the insurance companies have decided is high risk. And I'll finish by saying the insurance companies are supposed to be the experts in risk assessment. And yet they wrote policies 4 or 5 years ago. And now they say, well, we didn't really know what we were doing, but trust us now when we exclude coverage and jack up rates, we do know what we're doing now. So the idea that somehow public policy would depend upon the representations that the insurance industry makes is just really baffling. Thanks.
Thanks, Bernie. Do any of the panelists want to respond to any of the stuff that Bernie said? Or shall we leave it with his astute remarks and go to another question?
I just think it just reinforces, I think, how we open this up, right? About how narratives, predominant narratives can invisibilize these sort of messier, longer processes, right? And I think the example of insurers claiming authority, but not being able to follow through a few years later is a perfect example of the fact that there are, in fact, a lot of different dynamics at play that determine whether or not a market can work. Again, things that get erased from those narratives that we see commonly. But a lot of that tracks, I think, with our experiences, you know, knowing the other panelists a bit. So it's a great intervention.
And I would just briefly add that bestowing all of this trust in insurers being the sole arbiters of risk runs into another problem of state capacity, which is that in 40 state insurance offices, you have only 3 actuaries available to review rate filings. A lot of the insurance rate regulation that exists is itself somewhat delegated to private insurance sector as well. And that is also a problem of state capacity that needs to be addressed as this crisis intensifies.
Yeah, thanks. Thanks, Jordan. Thanks, Zach. Okay, so we have just a few more minutes left, and we have a couple questions and a hand up. So one of the questions was about state level action around insurance company fossil fuel investing. Jordan spoke to that a bit already, so I'm gonna skip that one. Sorry, John. And then I see Ashley with a hand up. So Ashley, if you could make your question pretty quick, so we'll have some time for responses. Thanks.
Yeah, I guess my understanding, having just recently talked to Mortgage Bankers Association, Appraisal Institute, and several others within the residential market specifically, they all point the finger at each other. Well, it's the bankers' fault because they don't make us do this. It's the insurance fault because they don't value it. The appraisers don't, et cetera, et cetera. And so I'm just wondering if there's a world where, and given that like the finance world is complicated, you can't just like divest money from one sector and put it in another like tomorrow. But I think what I'm trying to understand, and Zach, maybe you can speak to this, because what are the options for homeowners? Because they get screwed either way. They lose their homes when there's a catastrophe. They can't get insured if they're in Texas and all the other places where insurance companies are pulling out. And then they're taxpayers, so they end up having to pay for it on the back end. So I just don't see a world where any of us normal humans can actually like come out on top without completely pulling out then. Is that the answer? Do we all just stop paying insurance? Because if the insurance companies don't insure our homes, our mortgages are now at risk, right? Because that's a mandate by HUD. It's like, what are we supposed to do?
Thanks, Ashley. Go
These
ahead,
are
Zach.
these are really, really big questions. And I think there are like a couple of different levels to think about this on. They're the more, I think, immediate questions of how we organize our existing institutions so that they can work a little bit less poorly. And then there are these sort of bigger questions. And I look to people like Rebecca, who I think can guide us to some of the more fundamental questions about, how we're going to live. And these are longer term questions, which are about how we organize our society. Do we need to organize? This is a more controversial point, but I've got an alarm going off here. Organize our life around, property-based wealth. Does that make sense in a climate changing world? Or do we need to think about housing and shelter and wealth and prosperity a little bit differently? That's a really big question. But the really concrete one is, how do we organize our existing institutions? Here in the Netherlands, I've taken on with some colleagues a naive and impossible task of trying to organize the different public and private actors that contribute to this problem over many years with many different forms of expertise at the table to figure out if we can come to some sort of new common sense about how we organize these things. And it involves everything you said. It's everything from public infrastructure to mortgage finance, to insurance, to building codes, to actuarial practice, to appraiser practice. It's all of it. And it's about thinking about it as a system that organizes itself around particular goals. And I think that's tough work. But I think this is kind of the journey that we're on, partly. That's one level in which to think about it. And I think it is something that's not just academic. It involves housers, and involves folks in the building industry, and so on, all coming together. So it's a big puzzle. But I try to stay optimistic because I don't think we have another choice.
Yeah, thanks, Zach. That's a great way to end it. And I'll just close us out by noting that the one final question we didn't get to was also in some ways related to Ashley's question, thinking about, as individuals, as society, we're paying for the climate damages in our experiences and in the damage that it caused. How do we deal with that? And with this project that Climate and Community Project is carrying out, we're working with the folks on this call and many others to envision a way out of this, and we are planning to publish in the fall results of research that we're conducting, as well as initial attempts at a policy vision for tackling many, I won't promise all, but many of the issues that we talked about today. So please keep an eye out for that, and for coming blogs in our blog series, and certainly feel free to reach out with any questions or comments that you might have. And thanks all for your participation, and thanks particularly to the panelists.